Welcome to Early Edge Club. We are a small cohort of serious microcap investors. Every month, we deep dive into two microcap stocks chosen by the community. We are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. Today's section is divided into understanding first the business model, the industry, and then we use our 20-factor scoring, and finally our take on valuations and risk. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
The company that we are analyzing today is High Green Carbon Ltd. So High Green is in the business of advanced waste recycling. They basically take used and discarded materials that would otherwise end up in landfills, and they transform them into valuable reusable products. So their core business right now is taking waste tires and using a special process and technology which they have indigenously developed to break them down. The company's primary method is called continuous pyrolysis. You might not be familiar with the term, but it's essentially a high temperature process that heats up the waste material in absence of oxygen. Think of it like cooking without air. This process is highly efficient and environmentally friendly because it prevents harmful emission that you would get from simply burning the waste. So from this process, they get three main products. Recovered carbon black, which is RCB. So this is a high quality product that can be used to make new rubber products like tires, conveyor belts, and shoes. It's an excellent substitute for traditional carbon black, which is made from fossil fuels. So by using RCB, company can reduce their reliance on petroleum and lower their carbon footprint. Second, fuel oil. So the process also produces a type of oil that can be used as fuel in industrial application. And then Syngas. This is a clean burning gas that is similar to LPG. The company is innovating here by using the gas to power its operations, and it has plans to bottle and sell it to other industry, which is a major growth opportunity. High Green is basically part of the Radhe Group company with over 30 years of experience in manufacturing and technology. So this group has been involved in renewable energy and every projects like that from a lot of time. So the company has a strong foundation on a proven track record, having operated its first pyrolysis plant since 2012. This experience gives them a significant advantage in the new and growing industry. High Green Carbon takes old end-of-life tires, something we usually think of as useless waste, and turns them into a valuable products using our pyrolysis technology. So as I mentioned, I explained the process. This is a process in which you get 100% of the output. So whatever we put, so tires and all the materials we put, so out of that we get everything. 100% output is there, so there is no wastage or anything. So that is a good thing. So mainly, let's explore the products. So RCB, recovered carbon black. Think of RCB as the flour for making rubber products. It's a fine black powder recovered from tires, used in tires, hoses, belts, gaskets, plastics, and inks. Normally, carbon black comes from crude oil. We recover it from waste, which lowers cost and emissions. Because our process is continuous and in-house, we can make consistent grades. RCB for us isn't a commodity. We already supply 50 plus customers in India and abroad. Then pyrolysis oil or fuel oil. So this is the first liquid output similar to furnace oil. Industries burn it in boilers, heaters, and kilns. Margins are thinner here, so it's more of a cash generator than a profit engine. It can also be a chemical feedstock. Our R&D with Manipal University looks at upgrading this into a higher value chemicals over time. Next product is sodium silicate, which is water glass or raw glass. So they use the Syngas, which I mentioned in the previous slide. So Syngas is also what we get from our process as energy to run a furnace that makes sodium silicate. It is an industrial chemical used in detergents, adhesive, paper, water treatment, and construction as a binder or sealant. Lastly, steel wire. So tires contain steel. During processing, we separate and recover it, then sell it to steel mills and scrap buyers. It's not the largest revenue piece, but it supports a true zero waste model and reduces the need for virgin steel. So if I tell you the split, so in FY25, 41% of the revenue came from fuel oil, which is pyrolysis oil. 31% came from sodium silicate and 22% came from RCB. And rest 0.15% came from steel and other things. So now let's look at the industry overview. So the global tire recycling market is projected to cross $8 billion by 2030, with India and Asia Pacific region driving much of that growth. This isn't a small niche, it's a fast growing sector with huge potential. So why is this happening? So three major forces are driving it. Stronger environmental regulation. So in India, the new EPR policies for tire is a game changer. It makes tire manufacturers responsible for recycling, creating a steady, organized supply of waste tires for company like ours. Management has already seen sourcing became easier since this policy came in. Next, the circular economy shift. So we are moving away from the old take, make, throw away model. High green fit perfectly into the new circular model, turning waste into valuable products like RCB, Syngas, sodium silicate, and recycled steel. Next, lastly, demand for sustainable materials. So automakers and other industries are under pressure to use greener inputs. Indian recovered carbon black market alone is expected to grow at a 13% CAGR from FY25 to FY35. Now the challenges and why are companies ahead of them. So quality and standardization. So many small players use outdated batch processes leading to inconsistent quality. Our continuous pyrolysis technology produces consistent high quality output meeting industry standards. Next, high capital needs. So setting up plants isn't cheap. So our company follows a 50 is to 50 basically debt to equity strategy, which keeps finances balanced while we scale. Lastly, industry reputation. So some informal plants cause pollution with SCB pushing for cleaner continuous pyrolysis. We are already compliant and positioned to benefit from formalization. Now let's see the management of the company. So High Green Carbon is led by Mr. Amit. Mr. Amit, who serves as both MD and CFO. He is part of the Radhe Group, which has been in technology manufacturing for over 3 decades. So we are not talking about first-time entrepreneurs experimenting with something new, but seasoned technologists who have taken multiple ideas from concept to commercial scale. So they are very experienced in this. The continuous pyrolysis technology we use today wasn't bought off the shelf. It was developed in-house over 12 years. That's a strong signal that the team isn't just operationally capable, but also innovation driven. The fact that our first plant in Bhilwara started in 2012 and is still running at scale shows that it can operate reliably over the long term. Now let's talk about our facilities. So we currently have 2 operational plants and 1 under construction. So all strategically located to ensure efficient raw material sourcing and product distribution. So Bhilwara, Rajasthan. So this is our first and flagship plant operational since 2012. 2012 started at 25 metric ton per day MTPD and has scaled up to 100 MTPD, which is one of the largest continuous pyrolysis capacities in India. So this plant also produces sodium silicate using Syngas from pyrolysis process, showing our focus on value-added integration. Our second plant is at Dhule, Maharashtra, commissioned recently. This plant has already reached around 70% utilization within 5 to 6 months. So basically it opened in November last year. A unique feature here is the conversion of Syngas into electricity, which powers plant operations and could potentially be supplied to the grid in the future. The plant cost around 48 crores with an additional 10 crores for working capital. So this was funded through IPO funds used for this facility. And third, the facility which is currently under construction in Dhar, Madhya Pradesh. So this facility, CapEx for this has come from some funds left from the IPO and some from internal approval. So that is how we have managed the CapEx for this new facilities. So machineries are underway and it is expected to be operational by November or October this year. Others facility will focus on bottling syngas for industrial customers, opening up a new revenue stream beyond internal consumption. So it will do other RCB and everything else also, but this new thing, bottling of syngas also will be conducted in the new plant. So all our plants are 100 MTPD and this is intentional. So industry standards is often 50 MTPD or less, but our larger capacity means better energy efficiency and lower per unit cost, creating a significant competitive advantage. Also, from a raw material perspective, these plants are very strategically placed. They are placed near high tire waste generation zones and transport hubs, ensuring smooth supply, a benefit that's becoming even stronger thanks to the new EPR policy. Looking forward, the company plans a 10x capacity expansion over next 7 to 10 years, which would firmly position High Green as market leader in large-scale, high-quality pyrolysis and RCB production. Now let's look at High Green, their financials. The company reported a consolidated turnover of 96 crore. So this includes full year contributions from the Bhilwara plant, a few months of revenue from Dhule plant, and around crores from a new subsidiary, Samsara Recycling, which makes crumb rubber. So over 3 years, EBITDA margins have come down from 26% to around 20%. So this has happened mainly because expansion costs are now flowing through the P&L. So overhead costs and everything we are facing. Next, fuel oil, which is a lower margin product, still makes major chunk of our sales, as I mentioned in the revenue split. And raw material, as per the management, some raw material price had also increased. And the Dhule plant, revenue from Dhule plant, there only the production of oil was only there. So RCB and everything was not started yet. So that is not included in the profit. So that is why the EBITDA came down. But the long-term target of margins as given by management is around 20 to 25%. And the company's fund, so as I mentioned, their fund allocation strategy, expansion, capex strategy is basically 50% debt and 50% equity. Now for FY26, so FY26 will be the first year with full year contribution from Bhilwara and Dhule, plus a partial year from Dhar plant. So this combined with EPR driven ease of raw material sourcing and high margin product focus gives management confidence in strong revenue and profit growth going forward. So now let's see the key takeaways and highlights. So aggressive expansion, the company is very bullish and plans to expand its capacity by 10 times over next 7 to 10 years compared to its pre-IPO levels. New plants are being constructed in Dhule, now operational in Dhar, which is expected to be operational by October, November of the current year. Second, the company has developed its continuous pyrolysis technology, which it believes is a key differentiator. It produces recovered carbon, which it sees as a specific product, not a commodity, and syngas, which they plan to bottle and sell to industries. Next point, the new extended producer responsibility EPR policy is organizing the collection channel for waste tires, which the management expects will make a raw material sourcing easier and more consistent. Lastly, they are exploring various ways to monetize syngas, including generating internal power, selling power to the grid, and bottling for industrial use. Now, the bull case. So, High Green's focus on large-scale 100 TPD plants provides a significant advantage in energy efficiency and economies of scale compared to smaller competitors. The company's in-house developed technology and ability to produce consistent quality RCB would lead to market leadership. Then the shift towards a circular economy and implementation of EPR policy as structural tailwinds, it will increase the availability of raw materials and create a more organized market. Next, as the company scales up, the focus on higher margin products like RCB and monetizing syngas would significantly improve its profitability. The ongoing R&D with Manipal University could also unlock new high-value products from their fuel oil. Next, and lastly, the company's clear roadmap for a 10x capacity increase and its preference for a balanced 50% debt, 50% equity capital structure for new projects shows a strong commitment to growth. Now, the bear case. So the company's EBITDA margin have fallen from 26 to 20% in last 3 years, largely due to the reasons I mentioned. The company's ability to maintain its target of 20 to 25% remains a key concern now. Although they are saying, but will they be able to maintain these margins? They know in the future. So next, while High Green has over 50 customers, the call highlighted that major Indian tire manufacturers are still in the research phase for adopting RCB even at an association level. So this could delay the widespread adoption and pricing power of the primary product. So this is the point which even I think it is a bit of a problem for the company, because these things, as per the management, the RCB and everything, it is just 4 to 5 years old at max. So it is a product which is very new in the market, and there is basically an industry creation needs to happen. Now, especially in India, because in other countries there are some benefits given to the manufacturers who are using this. But in India right now, there is no such policies. There is not much adoption. So this is a bit of problem that they are right now. We can say they are too early, but policy change can happen quite quickly. So then our company can benefit from it. Next, the company's ambitious 10x expansion plan involves significant capex and relies on successful and timely commissioning of multiple new plants. So any delays or cost overruns could impact profitability and growth projection. The last point, so company's decision to put the J&K plant on hold due to geopolitical issues and waiting for clarity on subsidies indicates that its expansion plan are not immune to external factors which could slow down its growth trajectory. Now, moving forward to our framework, Section 1, Governance and Promoter Behavior. So, fundraise state, so they had a fresh issue raising 42 crores and offer for sale of 7.8 crores. So, here, OFS, so there was some promoter holding which was sold, promoter had sold basically. And from the fresh issue, 17.8 crores, which is almost half of the issue, went to that Dhule plant, setting up that plant. And rest went for working capital. So because working capital part is a bit high in OFS, also promoter had sold. So that is why I gave a 3 and 5 score. That promoter track record, if you say so, promoter track record is clean. So they only have majority of the shareholding via their individual holding, as well as their another company, RNG, Finlay's whole company. Through that company, they have another holding. So that is why I gave a 5 and 5 score. Related party transaction, as you can see, there have been some related party transaction. So that is why I gave a 3 and 5 score. So it is mostly loan received and all that, purchase of goods and all. So although the amount is not that big, I still gave a 3 on 5 score. Now, board independence and composition. So it is a professionally managed board. There is no family on board. Out of the 7 directors, 3 are independent directors. So I gave a 5 and 5 score. Key, if you see remuneration also, it is good. So I give a 5 and 5 score. Key person designation is not there. So no one had resigned in the recent years. And auditor designation was also 3 years back. So that is why I gave a 5 and 5 score in both of these metrics. Auditor opinion has been unmodified, but credit opinion for FY25, so it was given that issuer is not cooperating. So that is a bit of a problem. So that is why I gave a 3 and 5 score in this metric. Regulatory and legal issues. So there were some mentioned in the RHP. So basically it's 10 crore of claim against the company and 55 lakhs against the promoter or few people in the board. So that is why I gave a 3 on 5 score. I think it was mainly income tax issue and everything. So that is why I gave a 3 and 5 score. Investor communication and disclosure. So PPT and con call is there, but they have just uploaded in June 2025 only. So before that, they have not done anything. So that is why I gave a 0 and 5 score there. Section 2, financial health. As you can see, customer concentration risk is there. That's basically business concentration risk. For FY25 and FY24, I did not find the figure, but these figures are in the RHP. So that is why I gave a 3 on 5 score. Cash flow by EBITDA also, if you say, it is not that good. So it has been variable. Also, it is not, it is a bit low. So that is why I gave a 3.5 score. Revenue receivables as a percentage of revenue is fine. There is no problem here. So I gave a 5.5 score. Inventory days were a bit high. So that is why I gave a 3.5 score. Similarly, for the cash conversion cycle, also it is a bit high. Although we cannot compare it because there is not any listed company in this particular type of business. So I think mostly this inventory days and cash conversion cycle is high because we see their payable days is less only. So inventory days is mostly high because of their process. I think that is the reason why the cash conversion cycle and inventory days is high on the higher side. But still, I gave a 3.5 score for both the metrics. Capex by revenue. So capex by revenue is a bit high, a lot too much high. So I gave a 0.5 score for that reason. But that level in interest coverage, so that has increased, as you can see. The interest coverage ratio has also come down a bit. So that is why I gave a 3.5 score. Quick ratio, current ratio is good. So I gave a 5.5 score. ROE and ROC has come down drastically. So that is why I gave a 3.5 score. So we'll have to see how it performs in the future also. And same goes for revenue growth. It is not that, and the margins have also decreased. So that is why I gave a 3.5 score here. Overall, the score comes out to be 68. And for the valuation and final take, I'll hand it over to you.
So overall, a company which is doing a product that is not yet widely accepted in the market, and carbon black is widely used in tire manufacturing, and generally tire manufacturing brands are very, how do I put it? They're very careful as to what kind of carbon black, because it's a critical component which is needed in the tire, and very careful because it can affect their whole brand. And that is one of the reasons why they are taking their time in terms of incorporating maybe this new recycled product, though they know recycling product can increase the ESG score, etc. So that is one that I would like to highlight. Now coming to the valuation part of it, the new capex have come. So I think what is the management guided on the revenue growth?
No, so they did not give any guidance or such.
Okay, so there's
only the margin guidance they gave.
There are two new plants that are coming, right?
The only one plant is upcoming. So one is already operational. One is completed its construction.
Okay. So FY26 will reflect that number as well. Yeah. So considering the capex they've done, I think they should be able to do more than 108 crores. They've done already 97 crores last year. But anyway, since it is we don't have the option to edit the sales, we'll just go with this number. Your margin guidance is 23 level. I would, price to earning is higher for me. I would not give more than 25 in terms of the PE. But again, which gives you a number of 191. The current trading price is 209. And it is trading at a PE of 47. So since the revenue is going to be much higher than what is mentioned here, and the PE of 25 and 199, I think at the current price, the level looks more justified. And let's take a longer time frame to understand how the company actually is looking. I like that they are cash flow from operating positive. Their working capital is, apart from inventory, is pretty okay. Even FY24, I was just checking why there was negative operating activity. It is basically because some loans and increase in payables, a decrease in payables. But otherwise, even if you remove the loans, it is still positive. So that is again a positive for me. Yes, few corporate governance issue, but then we have given a score for investor communication, etc. as 0. Now they've started doing it from this year, so I hope they continue, and recursively, like going forward as they continue. The free cash flow is negative because they have just completed this whole huge capex, and cash flow from operating activity is 12. Net profit is 11. So just let's take the number 11 as the required as a earnings, and the required rate of return of 25, terminal growth rate of 3, and number of years as 5, which is going to be a holding period. And 5 years multiple, I would go with a max 20. I'm being a bit lenient here. 15 is a more convenient range for me. So the implied growth rate comes down to 42. So they have to go do a CAGR of 42%. This looks a bit stretched for me. I'm again being very aggressive with the earnings, because once the capex cash flow kicks in, this earnings number can drastically change, number one. And if your required rate of return becomes 20, and if you then calculate, it falls down to 37. So a lot of assumptions are going inside this. But however, I would probably wait for a bit more clarity on the product uptake and the capacity utilization of the new plant before jumping my guns, and also the market adoption. That is the major concern that we have. So these, if you're analyzing the company, please keep these points in mind.
I hope you found this framework useful. If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20-factor scorecard, feel free to share your score and how it compares with ours. If you found this useful, consider subscribing, and also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research first cohort, the link to apply is in the description below. Thank you for watching, and we will see you in the next one. Bye-bye.